Here we have a diagonal axis line. So, diagonal axis study on the S&P E-mini futures daily time frame. Now, as we know, most axis lines, or the ones we've studied, act as horizontal support and resistance. But we cannot negate diagonal axis lines. Although they're not as common, they do occur in the market. The same principles and concepts apply. They are an area of structure, therefore we must pay close attention to diagonal axis lines. Now, this one. So, it begins its life by holding support here 4 times. By the time we get to the 4th time, for the 4th touch, or maybe perhaps a 3rd touch, we draw the line in. Now, at this point, we're not thinking it's an axis line, it's just a simple demand line, which we'll be going over in our next study. So, but the important bar, okay, what kind of validates this level is this down bar. Okay, note the effort it takes to break. The largest spread we have at this area, maybe even rivals this spread. So we have 4 touches and a valid break, force of selling. So this tells us in advance, it gives us a license to look for shorts along this area because it should now act as resistance. Okay, and if we have a watch list and we print this bar, okay, then the following day we would want to analyze the market very, very carefully because we'd want to see either demand tire up here or supply emerge. As we revisit, what was once support now acts as resistance. We hold twice, once, twice, and we have weakness. Okay, they're narrow spreads. They close off the highs, which indicates selling. And where are we? At resistance. Okay, there's selling pressure here. We can short. Okay, boom, we get a move down. Instant resolve, instant gratification. It's a great move down. And then we push up back to our resistance line. Now, this is interesting. This area is different than over here. Last time we're at resistance. Why? Look, we come up, reject. We come up, reject. We close on the lows. Okay. Now this area, we dip down, close firm. Dip down, close firm. Dip down, close firm. We're butting our heads against the resistance. I mean, it is acting as resistance in this area, but we're not reacting like we did here. Okay. Here we're kind of holding and we weaken resistance. Although we can't close, we're knocking our heads above it. It comes up, we dip down. We come up, we dip. It's trying to break, so we can see that resistance is holding. Now, this area is actually accumulation. Okay, it's a buying zone. It's not a support level. How do we know it's a buying zone? By the closes. All along here, all in this area. Every time we come down, we touch. Think about this. Every time we come down, reverse to close firm. Touch, reverse to close firm. Touch, reverse to close firm. We come down, touch to reverse close. Down, reverse close. Down, look, reverse. All along here, this is accumulation. Buyers force the market up to close it firm every time we dip in this area. This is very advanced market behavior, price action that we do study in depth at a later date. But as previously stated, once the course has been fully completed, come back, revisit these sessions, and you will extract a lot more info. Please don't be overwhelmed at this stage. I do tend to waffle far from the subject at hand, and I apologise for that. Now we break through 7 consecutive days of buying. Now, for 2 whole months, we've been trading above this level. And then we start to come down, and we would expect this area, which was once strong resistance and previous support with validation here, we expect this level to act as support. So as we come down, we're looking for longs around here. Okay, it gives us a license to look for a trade. I mean, this is true. This is fascinating. It's truly remarkable. The S&P's is the most liquid futures contract in the world, and the axis line is working. It's valid. I mean, diagonal axis lines are extremely niche. A very small handful of people are aware of this piece of structure, let alone trade it. But how can one argue its validity? We can see the axis line working. It's uncanny. It's phenomenal how this stuff works. But more importantly, it is readable. Are there any questions? On the last R, why don't we break with a wide spread? On the last R, why don't we... Good question, well observed. Fairly easy answer, which is it's simple and complex, paradoxical. Okay, we don't need to see a wide spread with volume. Why? Because all the selling pressure has been eradicated. It's been absorbed from all this action here. Okay, think deep about what's occurring. We've previously spoke that this is a buying zone. And what happens in a buying zone? Well, what is happening here? Well, see these bars, they all dip down. So the professionals or whoever, all the large funds or whoever's in this market at the time, they withdraw from the market and then they buy it and reverse it to close firm. They withdraw from the market, so it's left to retail. When it gets in this area, they start buying to close firm. Again, withdraw from the market, then they start buying, reverses to close firm. They do it here, here, here. Okay, reverse to close firm. Dips in here, then they get a nice bit of buying here. Now the key bar is this bar. Why is this the key bar? Sorry, this bar is the key. Why? Because it doesn't dip down. Okay, this one right from the close, it's a small little dip, and then reverses. So it just, all this is active buying. This means they are ready for high prices. They just buy the bar. They don't need to dip it down, which tells us they're ready. All this action in here is accumulating, which eradicates the selling. So if there's no supply here, we can break through the axis line with very little effort. Hence we don't get the widespread bar. See, over here we get buying. You get buying, you get buying, you get buying, you get buying. Get a little negativity, but it doesn't really achieve anything. We get buying off the lows. Dips under, reverse to close firm, doesn't really go anywhere. Okay, and then boom, we slam down. Because it's buying all along here, it takes effort. It takes a large force to break. Why? Because of the buying. This area acted as support, therefore it will take force, in this case selling, to push it through. But over here, it's very different. The market is very different. Over here we come from a buying zone, which naturally eradicates supply. It takes all the selling pressure from the market. The large operators in here, they add contracts to their inventory, bullish contracts, whilst eradicating supply. So before they eradicate supply, before they move it up. And it's a big difference to what's occurring over here. Now, this occurs much more frequently and more blatantly with stocks, which is one of the most manipulated assets in the world, but we don't need to go on another tangent. It's a great question. I hope it does answer. Yeah, excellent. Very good question. Well spotted.